In this week's video, we'll dig a little deeper into the concept of, is this stock market volatility to ignore, or is this stock market volatility to respect? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In this segment of the video, we'll be using some simple examples to illustrate basic concepts. Concepts related to how the model handles the transition from a bullish trend to a bearish trend. When we say in these videos that we're using generic moving averages to illustrate basic concepts, we mean that. And that typically means that the moving averages that we're looking at are not the moving average pairs actually used by the model. We're using generic daily moving averages here. They were chosen at random to illustrate basic concepts in terms of how the model will handle a trend reversal. We're looking at a daily chart of the S&P 500, 2007, 2008, and into 2009. Let's assume, hypothetically, for illustrative purposes only, that these moving averages were the entire market model. And obviously, that is far, far, far from the case. But if we make that assumption, we could ask roughly 20 questions about these moving averages. There's 10 of them. We could ask questions about the slopes. And then we could ask 9 additional questions about is blue over red, is blue over green, etc. That would actually be 19 questions, but let's round it to 20 for conversation's sake. Here in late 2007, all of the slopes, we're just zooming in on this portion of this chart. We can see this, we can measure it, we can put it in a model. This is a bullish trend. This is April 2007 here, and this is July of 2007. The answer to all of our questions would be yes. And for our hypothetical example, we could say that we would be 100% invested in SPY. Now we're looking at this segment of the chart and the exact same moving averages. Over here, all of the answers to the questions are 0 or negative. Instead of all the slopes being up, they're all down. Instead of blue being on top, when we ask the question, is blue above red? It's yes here in July of 2007, and it's no here in January of 2008. A complex system such as the global financial markets is not a binary system. We use binary questions to break down a very, very complex system into smaller parts to make it easier to manage. But markets are far from binary, and thus the market model is not binary. It is not an all-in or all-out model. Over here, hypothetically, in our oversimplified example here, we would be all in. As the answers started to migrate from yes to no, we would make incremental reductions to our exposure to SPY. So let's say we had 20 questions, and the first question flipped over from yes to no. Hypothetically, we could sell 5% of our SPY and hold the remaining 95%. If we did that between this point here and this point here, eventually we would scale all the way out of SPY and we would be out of the position here early in 2008 before really bad things happened. Since there is no magic moving average slope to use or any magic pair of moving average crossovers to use, and since markets are far from binary, the market model uses a wide array of inputs. This is a sample of some of the inputs. Moving average slopes, daily, weekly, monthly. Indicators, technical indicators like MACD, daily, weekly, monthly. Risk on, risk off ratios, daily, weekly, monthly. Moving average crossovers, daily, weekly, monthly. And asset class behavior on daily, weekly, and monthly time frames. There are additional inputs, but for conversation's sake, let's just move on. It's extremely important to note that we used backtesting to determine what to include, which moving averages to use, which crossovers to use, which indicators to use, and maybe more importantly, what indicators to exclude. how to use asset class behavior, which risk-on, risk-off ratios are helpful relative to tracking the health of the S&P 500, and which risk-on, risk-off ratios are not particularly helpful. There are numerous moving averages and indicators that when you backtest them, they actually can be harmful instead of helpful. So how do we use all this? We take hard data and ask nothing but binary questions which produce binary yes or no, 0 or 1 answers. No opinions, no subjective answers, no personal bias about anything. No personal bias about the Fed, no personal bias about the economy, and no personal bias about politics. The answers are weighted based on the back testing, and then everything is scaled between 0 and 100 to make it very, very easy to get a snapshot of the weight of the evidence. This allows us to make rational and unemotional decisions based 100% on facts. There are no magic bullets inside of this box or inside of the model. However, there are numerous inputs in the model that can help us assess the probability of good things happening relative to the probability of bad things happening. And since we've been working in the markets for a long, long time, I started at Morgan Stanley in 1994. All those years of experience help us interpret the weight of the evidence and help us understand what the model is telling us and what it isn't telling us. Therefore, if we circle back to the million-dollar question, is this volatility to ignore or is this volatility to respect? Since the market model is an incremental model, we could be fully invested here and then we scale out based on the weight of the evidence. The magnitude of the reduction in SPY is basically proportional to the magnitude of the deterioration in the hard evidence. If it's minor deterioration, we make an incremental move away that's relatively small. If it's significant deterioration, then we move much faster and in larger chunks, including getting 100% out of the stock market if that's what the weight of the evidence tells us. Which means the answer to our question in most markets is an incremental answer. It's not a binary answer. It's not, is this volatility to respect? It's not yes or no. There's an incremental answer based on the evidence that we have in hand. When we have very, very strong trends, it can be a binary answer. Is this volatility to ignore? Yes, everything still looks good. So looking back to Brexit and the US election, how has the core model performed? We've covered in recent videos some changes that we made relative to the ETF scoring system, but we're happy to report the core model is working extremely well and exactly as designed. As of July 19th, 2017, the average gain for our SPY positions that we started taking in June of 2016, so over a year ago, the average gain is a return, a total return, that includes dividends of 16.5%. Just as we scale out when a bear market comes, we were scaling in as the data improved. That's a 16.5% total return while monitoring risk, and we'll double back to that. And we're also happy to report that the model has held our core positions with little to no trading. Meaning, since taking these positions, the core model has said our core positions, any pullback has been volatility to ignore. And it's extremely important to view this number here in the context of risk management. Why? Because if our SPY positions are blind buy and hold, and we're not monitoring them and managing risk if needed, very, very bad things can happen with buy and hold using index funds. This is the Vanguard Index 500 fund. It lost 55.26% from point A to point B during the financial crisis. And if you have no way to monitor and manage risk, it can get very, very difficult to sleep at night during a bear market. In the dot-com bust, the same low-cost buy and hold Vanguard Index 500 mutual fund between point A and point B lost almost 48% of its value. How about if we use a pie chart and diversify for growth? Long-term viewers may remember that we covered this topic in the past, and we used a portfolio that was called the quintessential equity portfolio mix by a third party. So we did not build this portfolio. This portfolio was represented as being the best method to invest in the stock markets around the globe for long-term growth. And in fairness, it does say long-term growth. However, when you have a pie chart like this, typically feel that the pieces of the pie will help you in a downturn. If I ran this mix, this is my basic allocation, and the million-dollar question is, would the pie chart or the diversification from a growth perspective, would it have been helpful in the financial crisis? The answer is absolutely, positively no in this case. This portfolio from point A to point B, October 2007 to March of 2009, lost 59% of its value, which is actually worse than just holding SPY, a one-position portfolio, over the same period. Our purpose here is not to criticize this mix. History shows that this can produce very, very good long-term results if you are able to stomach and hold through the good and bad times. So we're not saying buy and hold doesn't work, but the question really becomes, can you sleep? And it's also important to note from a long-term perspective, the screen that we added, and we covered that screen in detail in May of this year in a video, the purpose was to build a portfolio that enabled us to hold positions similar to the way we've been able to hold SPY, reduce trading frequency. The screen that we added and covered in May will give us a higher probability of building a portfolio that will allow us to navigate from point A to point B and reduce our trading frequency and increase our holding periods. Why is that important? The setups that we have in place today, this long-term trend here in 1995, the stock market rallied for 4.5 years. And as we covered back in May, the screens will help us build a portfolio that gives us a higher probability of having positions that enable us to go from a point A to a point B. All of these returns that we covered back in May, this is 1995 out to 1998 roughly, 1995 to 2000, 205%, 234, 261, 533, and 251. In these cases, how many trades were required to capture these returns? The answer is 0. The model has no problem acting like a buy and hold investor during long-term bullish and strong secular trends if the data allows. Remember back in May, we said we wanted to build a portfolio that had positions that looked a little bit more like this. On May 20th, our SPY with 0 trades was up over 13%. VTI was up over 9%. If we fast forward to the present day in July, both of these numbers are over 16 now, still with 0 trades. Therefore, if this looks appealing, the screen that we added and the changes that we made back in May of this year to the portfolio actually helped us simplify our process and should improve our odds of capturing long-term gains with the context of 100% known and to be expected drawdowns and volatility that occurs even within the context of strong long-term secular bullish trends. Let's shift gears here a little bit and talk about correlations and the CCM market model. This is the S&P 500 here. This is the correlation between the stock market and SPY. This is a strong Positive correlation. We just want to see what a strong correlation looks like. It's 1. It tells us that they zig and zag almost in unison all the time. Same thing with the Vanguard 500 Index Fund. This is a strong and consistently strong correlation. As we've already covered in this video, the master market model has helped us stay bullish in a very difficult period, pre and post Brexit, pre and post US election. Remember, in this period, the futures went limit down, maximum fear 2 times, and the model helped us stay bullish. So going forward, we want to leverage the master model's strength, which is monitoring the health of the S&P 500. And more importantly, we want to profit from the model's accurate read of market conditions. This is the correlation between the S&P 500 and VUG in the ETF world. That's large cap growth stocks. You can see it is a consistently strong and positive correlation. For the most part, this zigs and zags in unison with the broader market, which tells us if the model is confident about the trend and we own this position and the model is correct, this position has a high probability of capturing these returns from point A to point B. So when trends are strong, this is what we want the correlation box to look like. We really don't want anything down here in the negative correlation territory. Why? In this instance, if the CCM market model was right in identifying this strong long-term trend and we owned DBB or base metals, this is a negative correlation between the stock market. It tells us that even if the master model is right in telling us to stay with this trend, this negative correlation and really all over the place correlation doesn't really give us much confidence that DBB is going to partake in this bullish trend that the master model correctly identifies. We said we didn't want to be down here during bullish conditions, and DBB is down in this red box for a considerable period of time when the market is trending. During this 3-year period, roughly, of an extremely strong trend, we have negative correlations in here, not what we want. And from this point to this point, a lot of negative correlations during a period when the stock market made money from point A to point B. If we owned VUG and stuck with the master model, not only did VUG move roughly in unison with SPY, the blue and the red, but it outperformed. This is really what we want. We want something that can outperform potentially and also leverage the risk management tools with the master market model. These 2 positions did very, very well. Even if the model correctly identifies this trend, DBB might zag when these 2 ETFs are zigging. And this is performance. This is losing money while these are making money. Still thinking about correlations here. This is IWF, large cap growth, has a very, very high and consistently high correlation with the S&P 500. Contrast that with something like metals and mining. So in this case, even if the master model identified this strong long-term trend in the S&P 500, if you own XME, you're not really sure if you're going to participate and make money while IWF is making money and SPY is making money. There's a lot of uncertainty with this position relative to the health of the general market. Once again, looking at returns. This is technology, for the most part, zigging and zagging with SPY and outperforming. This is performance here. This is the S&P 500. Not here. We're not capturing or leveraging the market model's trend identification as VGT or technology stocks can, especially when they have a long-term bullish trend relative to SPY. Blue technology and red S&P 500 are zigging. XME, metals and mining, is zagging. Let's dig a little deeper into the new screens that we added, the long-term screens, and why they're important. This is IWN small cap growth relative to SPY. This is a monthly chart dating back to calendar year 2017 here. If we bought, or we were asked the question, why don't you own IWN? It's outperforming SPY here. Why don't you own IWN? Why don't you own IWN? Why don't you own IWN? It would have been an exercise in futility here for outperformance because these are counter-trend rallies within the context of what currently is an existing long-term downtrend against IWN relative to SPY. We can see the 50-month moving average rolling over. Right now, this ratio has a full bore bearish look. Price below the moving average and the slope of the moving average is down. Could we get a trend change? Absolutely, positively, yes. But we invest based on what is happening, not what might happen. If we invested based on what might happen here, we would have been frustrated. Let's compare and contrast this long-term trend with the long-term trend of IWF, large cap growth, relative to the S&P 500 roughly over the same period, 2006, 2017, 2006, 2017. Instead of making a series of lower highs and lower lows, this trend is making a series of higher highs and higher lows. This is a bearish trend against IWN and in favor of SPY. This is a bullish trend in favor of IWF over SPY. It has a full bore bullish look on July 20th, 2017, with price above an upward sloping, turning up 50-month moving average. The probability of IWF outperforming over a long period of time relative to SPY is higher when we invest in a long-term uptrend and lower when we invest in what is currently a long-term downtrend. Now we can use the same long-term concepts to help us answer some additional rational questions in 2017. If we were shown these charts on a technical analysis test and said, which chart would you prefer to own? We would prefer to own the clear uptrend on the left. We would prefer to avoid the clear downtrend. This is a counter-trend rally within the existing downtrend. What charts are we looking at on July 21st, 2017 in set 1 here, and what can we learn? This is VUG, U.S. growth stocks, relative to global stocks, VT. You can see the long-term trend currently favors VUG over global or world stocks. The ratio recently made a higher high above this high. Prices above an upward sloping 50-month moving average. Compare and contrast that with global stocks, VT, relative to SPY. This still looks like, right now, a counter-trend rally within the context of an ongoing downtrend. Could this change? Absolutely, positively, yes. But right now, this chart really hasn't even made an important higher high above these highs here, and it has a full bore bearish look with price below a downward sloping 50-month moving average. This ETF has proven that it can outperform global stocks over a long period of time. This ETF, VT, or global stocks, in the present day hasn't proven anything about outperforming SPY over a long period of time. Why don't you own VT? Why don't you own VT? Why aren't we in global stocks? Fair questions, but when we look out at a longer term chart, the answer becomes a little bit easier from a probability perspective. This chart doesn't tell us what's going to happen next. We make decisions based on the facts in hand, and we're open to owning global stocks, but we need to see some improvement. Let's move to set 2, same concepts. We would prefer to own the clear uptrend on the left over the clear downtrend on the right. This chart is dated July 21st, 2017. July 21st, 2017 on the right as well. What are we looking at? This is the S&P 500 SPY long-term bullish trend. And this is foreign stocks, EFA in the ETF world, relative to the S&P 500. There are things to be excited about foreign stocks in the present day. In fact, most of our clients, we used a swap out trade where we sold an existing position and redeployed it into several positions. So if you're a long-term client, you do own some foreign ETFs. How do we handle this long-term downtrend? If you look at our allocation to that ETF, it's a European ETF, you can see it's very, very small relative to our entire portfolio. We're basically saying we agree that there's good things happening in the present day, but we want that ETF to prove something to us before we allocate more capital. The fact that we own a European ETF in 2017 says we fully agree, understand, see, and respect the good things that are happening, but we also fully agree with and can see and understand the longer-term picture and longer-term probabilities. The market will decide whether we get rid of that European ETF or we decide to allocate more capital to it. If this chart starts to morph into something like this, then EFA and all European ETFs will become more attractive. Now let's view these charts within the context of some of the goals of the market model. As we've said for numerous weeks and months, our goal is to navigate from a point A to a point B. So we want to build a portfolio that gives us the highest probability of capturing satisfying returns between a multiple year point A and point B. That's an objective in the present day market because we currently have strong trends in place. We will manage against this objective as long as the data that we have in hand tells us that we have a probability of having a multiple year move from a point A to a point B. This counter trend move here and this counter trend move here, if we owned EFA and we wanted to outperform, it would make it harder from a probability perspective to hold it for years in here. If we have something that's trending strongly when the market's trending strongly, we can hold it. This position would be difficult to hold between the same point A and point B because if you bought it here, it started to underperform. If you bought it here, it started to underperform. If you bought it here, it started to underperform. So in the present day market, when the math is strong, we look for satellite positions to complement SPY that are currently trending versus SPY on all time frames, including very long-term time frames, which is not yet the case for most foreign ETFs. Another objective in a strong trending bullish market, based on the data we have in hand, is to reduce the whipsaw risk via long-term ETF screens. This is your whipsaw risk: outperform, underperform, outperform, underperform, outperform, underperform. This ETF currently does not pass our long-term screens. It may in the future, but right now it does not. So we can see here that right now the trends don't favor EFA over SPY from a long-term perspective. Another point about foreign ETFs. If we own them blindly for the sake of diversification, they won't necessarily help us in a bear market. The portfolio that we covered earlier had 50% of its assets allocated to foreign ETFs or mutual funds. Most people would think that would have helped in a bear market in the United States. Well, these things typically zig and zag together, so when they're zagging, they tend to all zag together, and blind foreign diversification for the sake of diversification isn't necessarily helpful in a downturn. Some other very, very important points. When the market is trending strongly in a bullish manner, and the S&P 500 and SPY are making money and the data still looks good, we want to own positions with a high correlation to the market. The model manages risk. It monitors the need for diversification and risk management. Conversely, as we've just shown with the foreign ETFs in the pie chart, when the market is trending strongly in a bearish manner and losing money, we want to own positions with a low or negative correlation to the general market or SPY. This is the S&P 500 in 2003. If we knew in advance that the S&P 500 was going to rally for 4 years into calendar year 2007, we would want to own ETFs that have a high correlation to the S&P 500. Why? A high correlation means they move in the same direction for the most part. If the S&P 500 is going to make money into calendar year 2007, we want to participate. If we own something with a negative correlation, when the market's moving in this direction, it means it's going to move in the opposite direction. So diversification can be harmful when the market is trending in a strong, bullish, and confident manner. So the data right here was confident, telling you that it was prudent to have an allocation, a heavy allocation, to highly correlated assets to the S&P 500. So in the context of this multiple year move, when the market is trending strongly in a bullish manner and making money, we want to own positions with a high correlation to the market. And that doesn't mean along the way we're not managing risk in here. This is significant deterioration. But if the big picture still looks good, we're also erring on the side of redeploying capital quickly when the market can right itself. So a move from a point A to point B doesn't mean we throw risk management into the trash can. The market model would definitely be making moves in some of these areas here in an incremental manner. And then as the market started to improve, the capital would be redeployed. The reason why you can't give up risk management blindly, eventually your sideways movement and the fact that you're making incremental adjustments, eventually something like this morphs into something like this. And if we're making incremental moves inside of the box here, we can migrate from a stock portfolio to a mixed portfolio. Now, low correlation and negatively correlated assets, the further we move along and the further the data deteriorates, the more and more they make sense. Here, I want to own negatively correlated assets. When the market is trending strongly in a bearish manner and losing money, we want to own positions with a low or negative correlation to the market. Remember, we manage based on the facts in front of us, not what we're fearful about or what may happen. Present day trends mathematically are extremely strong, so we can move quickly here. Weekly moving averages for illustrated purposes only. This is what our peak looks like in 2007. Here are the exact same moving averages on July 20th, 2017. This looks like a strong and sustainable bullish trend, which speaks to probabilities about good things happening. Same moving averages with the transition from bull to bear in 2000. This is a waning look to a trend. Look how many months it takes. Look how close the moving averages are. Look how much volatility there is. It will normally take time for this to morph into even something like this. This is February of calendar year 2000. This is where the really, really bad stuff started to happen. And this is where you would want to already have some low correlation and negatively correlated assets mixed in based on the deterioration in the math. Not at this point. How much mathematical deterioration have we seen in the present day, which would speak to risk in the present day? The portion of the market model that follows trend strength asked 207 binary questions, similar to the examples that we've shown using these charts. What was the lowest weekly score that we've seen year to date in calendar year 2017? And keep in mind, even the submodels are scaled between 0 and 100. 100 would tell us that 100% of the questions that we're asking are coming back strong trend and bullish. What was the lowest score we've seen year to date? The lowest. As of last Friday, it was still 100, and the market went up this week, so most likely when we check it again, it will still be 100. The lowest score that we've seen, speaking to the health of the S&P 500, was 98, telling us that 98%, based on the weighted average of the 207 questions that we're asking about present-day trends on multiple time frames, are coming back bullish. As of a week ago today, it was 100%. Mathematically, we still want to own assets that have a very high correlation to the S&P 500 for the reasons we've discussed. When we have an extremely strong trend, as we do in the present day, mixing in negatively correlated assets into the portfolio, or even low correlation assets, just adds uncertainty to the equation. And the negatively correlated assets within the context of a strong trend could actually hurt us, because when the market zigs, they would zag. Same moving averages: Dow 2007 peak, Dow July 20th, 2017. NASDAQ transition, NASDAQ July 20th, 2017. Maximum flexibility is always important, because we know eventually volatility to ignore will morph into volatility to respect. Right now, the default is a long-term secular bullish trend, because that's what the data says that we have in front of us today. If we want to navigate between point A and point B, we have to try to avoid these common missteps, including trying to own every ETF. We monitor basically every ETF on the planet. The ETF scoring system is tracking something on the order of 234 different ETFs. We also want to avoid trying to be right 100% of the time. Trying to build a portfolio that gives us the highest probability of capturing satisfying returns within the context of prudent risk management between point A and point B. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.